Have you ever wondered how the rich get richer? What do they know that the rest of us don't? Are there secrets they're keeping from the masses to grow their wealth drastically? This is called infinite return. Is that salary is taxed at a higher rate than capital gains or dividends. It enables you to grow your wealth tax-free. What's up, everybody? Julian here, and today I'm going to expose some wealth building strategies that they do not teach you in school, and definitely no mainstream media is talking about. I personally have used these secrets to build an 8-figure portfolio, and most millionaires are using these exact tactics to grow their wealth. So buckle up, because by the end of this video, you'll not only comprehend how the wealthy build their empires, but also why these strategies are crucial for anyone aspiring to elevate their financial game. So let's dive right in. It should be no secret to you that most wealthy people became rich by acquiring real estate and through owning businesses. But today, I won't be talking about the vehicles to get rich, but more about the strategies on how to maximize your returns and get closer to your financial goals. So secret number one, you have to have rich parents.
Rich parents, don't forget rich parents!
So more seriously, number one, leveraging other people's money to buy real estate or business. Now let's talk about the real secret sauce here, the concept of leveraging. Imagine having the ability to acquire prime real estate without exhausting your own funds. That's where leveraging comes into play. Successful entrepreneurs don't just rely on their own capital. They leverage the power of banks or they raise investors' money to acquire properties that would otherwise be out of reach. If you could get a piece of real estate or shares into a business without putting any of your own money, then when the business is making profit or when you're collecting rent from your property, you're getting a portion of it. This is called infinite return. Let me explain. When you invest $1,000 and you get $200 back, that is a 20% ROI or return on investment. But now, if for the same investment, you have raised $1,000 from investors and you don't put any of your own money, you'll share the profit of that investment 50-50. So just like in the previous example, you and your investors are splitting the 20% returns. And because you didn't put any of your own money, you are making 10% on $0 invested. That's the power of infinite returns. It's a financial instrument that, when played right, will build the foundation to your wealth and accelerate your growth. Of course, if you are a beginner, it might be difficult for you at first to raise money from investors since you are lacking some experience. So instead, start with the bank. Getting a mortgage is essentially leveraging the bank to buy a property you could not have afforded otherwise. One of the ways I use to get infinite returns when I buy a property is to use a line of credit for the down payment and get a mortgage for the remaining amount. It allows me to get an income property with none of my own money. And if you are a seasoned investor, the concept of other people's money should already be in your arsenal. Number two, the refinancing and getting equity out instead of selling real estate. So let me start by saying that you only pay capital gain when you are selling a rental property. So if you're not planning on selling, then there will be no taxes to be paid. That's why rich people acquire income-producing assets like real estate, business, or dividend-paying stocks. And when they need access to capital, they refinance instead of selling. The magic lies in the ability to tap into the equity of real estate without liquidating the assets. By refinancing, they achieve two things. They are accessing equity that can be reinvested into new ventures or further real estate acquisitions without paying any taxes. And the best part is that they keep the assets that produces income. If you have an asset who's paying you regularly, why would you want to get rid of it? Exactly, you won't. In fact, I'm sure just like me, you would like to acquire more of them. The rich understand that, and that's why they keep getting richer. Another thing to note is that the fact that you add some debt to the property, you are also now paying less taxes on the income it produces. Not a bad operation, don't you think? Let me know in the comments down below if you ever refinanced a property to get some equity out. And what did you do with the money? Number three, income. Typically, rich people don't get most of their income through salary. They do through dividends, capital gains, or leverage. Even if you're not a business owner or an investor, take CEOs of large companies. If we take Apple, for example, in 2022, Tim Cook made $3 million as a base salary, plus another 12 million in bonuses. But about 83 million was in stocks. That's roughly 85% of his compensation that was paid in equity. And the reason is simple, is that salary is taxed at a higher rate than capital gains or dividends. And I know what you're going to say. 15 million is a huge salary and a lot of money to pay taxes. But nevertheless, they still give him 85 million in stocks. So he doesn't have to pay or very little taxes on it. And most CEOs are paid exactly the same way. Well, let me show you an example on how personal income is taxed versus capital gain. If you are making $100,000 in gross income, your tax rate will be around 35% or 35K, leaving you with only $65,000 out of the $100,000 you were paid. Now let's compare salary to capital gain. So if you sell a property and make $100,000 in profit, that is called capital gain. For taxation purposes, you take half of it, so 50K, and that will be added to your personal income tax. To keep it simple, let's assume that you are still in the 35% income tax bracket. And keep in mind that if it is the only income you've made this year, the tax bracket could be even lower. So the $50,000 gets added to your taxable income. So therefore, you will pay $17,500 in income taxes, leaving you with $82,500 in your pocket. Which already you could see that capital gain is much more attractive than personal income. But what the rich do that's even more attractive, instead of selling that property and pay capital gains, they refinance it, just as I previously mentioned, to extract $100,000 worth of equity. And by doing so, they are adding that $100,000 more in debt at the rate of their current mortgage. Let's say if it's 6% for this example. Since this is debt, there's no taxes to be paid, and it will cost them $6,000 per year. That is not only a way more attractive option, but also they still own the property, which will go up in value with the inflation, while also bringing in rental revenue. Can you see how everyone is not playing the game with the same cards? I can already hear you complain on how it doesn't seem fair.
Unfair! Unfair!
And you're right. The way the system is designed, it's not fair. Politicians and regulators are making rules in favor of banks. I do believe the system is poorly designed, and ideally, paying taxes should be more attractive for investors than paying interest to the bank. But unfortunately, that's not the case. That's why I feel like the system is rigged. But that's a story for another video. At the end of the day, those are the rules, and you have to know and abide by them if you want to get ahead. The rich certainly do. Number 4, the tax game, or deferring payments legally. The rich understand how to optimize and delay taxes legally, and by doing so, they retain more capital that can be strategically deployed for growth and wealth building. It's a strategic maneuver that allows them to play the tax game like seasoned champions. We're not talking about tax evasion here, but rather about how to play the tax game strategically. As you might be aware, it was revealed a few years ago in the Panama Papers, for example, that some corporations and individuals are cheating the system and literally evading taxation by hiding offshore parts or all of their earnings to avoid paying taxes. But what I'm about to tell you is a legal strategy that allows corporations to lend money to each other to reinvest. So let's say you own a business, it's a coffee shop. So we call it company number 1. And you made for this year $100,000 in profit. You have to pay corporate tax, which is about 16%. So you'll keep $84K in the company. And if you decide to get money out just to pay yourself, then you'll get taxed again at a marginal rate, which is about 15 or 30%, depending if you are giving yourself a salary or dividends. Either way, you'll be left with between 59K to 71K. Ouch. That's a big gap compared to the $100,000 you made in profit. I'm sure we'll all agree that if you had an extra 15 or 30% of your income to reinvest every single year, you'll get to your financial goals way faster, right? Okay, so let me show you how the rich are able to reinvest the whole $84,000 for years before they have to pay the taxman again. So once you pay the corporate tax, then you start a second company, let's call it company number 2, to buy real estate. And you lend the $84,000 from your first company to use as a down payment to buy a property. Since the money is still in the corporations and it did not come out to you, the individual, There's no extra taxes. So now company number 2 owes company number 1, but he was able to use the full amount or the $84,000. And over time, company number 2 will repay company number 1 the full amount. So your first company has $84,000 that can be deployed again, and company number 2 owns the property. Now you can just repeat the process. You open a third company, and company number 1 will be lending the $84,000, either to open a new coffee shop location or to buy another building, and then so on and so on. It's a great way to build wealth, isn't it? That is one of the many reasons for having corporations. Basically, in a nutshell, as long as the money stays within the companies, you can lend it and reinvest it. It enables you to grow your wealth tax-free. And you will pay tax in the future once you want to get the funds out of the companies for personal use. But hopefully at that point, you created enough wealth that paying taxes doesn't feel like a burden. And remember also that with inflation, your dollars today are worth more than your dollars in the future. So, keeping as much of today's dollars is key to build your financial independence. The misconception about wealth building is that it's reserved for a select elite. The truth is, these strategies are accessible to anyone willing to learn and apply them. It's not a secret society. It's a knowledge game, and the more you know, the better you can navigate the road to financial prosperity. Number 5, inflation. Another concept that most people don't comprehend, but the wealthy understand very well, is inflation and money supply. So they know that they have to grow their income and net worth at a faster pace than the current rate of inflation. Basically, if they don't want to fall behind, they need to make a bigger return on their money than the rate of inflation. So for example, if the inflation is 4%, you need to invest your money at least at 4%, just so you don't lose any of your purchasing power. So to beat that, you'll need to find an investment who can yield 5% at least. One key point for you to take away on your investing journey is that inflation is eating away your hard savings. What do I mean by that? If you leave your money sitting in the bank, it will erode your net worth little by little. A lot of people are scared of investing their money, whether it's in the stock market, real estate, crypto, or whatever asset class it may be. And it's because the lack of knowledge or whatever excuses they tell themselves. But the reality is that they should be worried of not investing, because by leaving their money in the bank, not only their savings are losing 3 to 4% in inflation, but also they're missing the growth of an asset year over year. So for the rich to get richer, they leave as little money as possible in the bank and they buy assets instead to beat the inflation. These wealth building strategies aren't elusive dreams, they are a blueprint for success. Once you understand inflation, leverage, and tax deferral, you'll be better equipped to navigate the financial system. And remember, these are not financial advice, but rather strategies that I have used to create my financial independence. And with careful planning and strategic thinking, these strategies are within reach. Make sure to reach out to professionals like chartered accountants and corporate lawyers to double check that your strategy is viable and is getting you closer to your goal. Trust me, it is well worth the money to avoid costly mistakes. If you found this video valuable, please hit the like button, subscribe, and share your thoughts in the comments. Until next time.